Upadhyaya joins us. Harsha, good morning. Thank you for joining us. Harsha, where do we go from here? I mean, this market is no longer cheap, but this market is not expensive. So what happens now? महंगा नहीं है मगर सस्ता नहीं है.
Good morning. I think you rightly put it. I think the undertone continues to be quite bullish. So from that perspective, there are no concerns. Liquidity continues to be very strong. We have seen about $10 billion of FII money coming into Indian markets this quarter. Similarly, the SIP numbers have continued to be very, very strong and sticky. So no issues in terms of sentiments or liquidity, just that at higher levels, obviously, the valuations are high. So to that extent, I think in the very short term, there is no room for disappointment. Earnings will have to definitely have to get delivered. Only then the markets can sustain these levels or higher levels. But even there, I think things are falling in place. Commodity inflation has cooled out. So to that extent, there is going to be some bit of margin expansion. And if demand continues to be resilient, then I think we will be able to see earnings growth, which is going to be better than what we have seen in the previous few quarters. So in that sense, if earnings delivery comes through, then markets can sustain these levels or slightly higher levels.
I think earnings delivery will come through. What is your sense?
We are positive. We believe that at least in the large cap basket, earnings are going to be resilient. That's what we have seen even in the fourth quarter. For example, the fourth quarter results were better than the first 3 quarters for the financial year. However, the same cannot be said about mid caps and small caps as yet. They will also get the benefit of margin tailwind, but whether all of them will get the kind of tailwind that is required, given the way the stocks have moved up, is still a question. So to that extent, during the earnings season, we could see a little more volatility in the mid and small cap basket as compared to the large caps.
Harsha, hi, morning. What is it that you're making of, the IT pack right now? We were just looking at the stats, and TCS, Infosys, the heavies from within IT are still way off from their all-time high, while the index is already at that peak and clocking newer highs on a daily basis. Do you think after the recent sort of recovery that you've seen, at least in the mid-cap IT names, the tide could change for IT soon?
Aisha, I would say it's more than a recovery for mid-cap IT. In fact, most of them have gone up much higher in terms of valuations at this point of time. So to that extent, just like the overall market, there doesn't seem to be much value that you can see in the mid-cap IT segment. However, the situation is quite different in the large cap IT basket, where valuations are quite reasonable. And also this has been one of the underperforming sectors for the last 1 year. So to that extent, there has been under ownership from an institutional perspective as well. So in case of market volatility, we could see this sector kind of giving you some defensive bias. At the same time, we should also remember that in the very short term, both the commentary as well as the momentum continue quite weak, even for the large cap IT.
Harsha, hi, morning. Now, given the fact that a lot of the headwinds for the auto sector, rising input costs, a stagnant demand, all of these things are becoming things of the past, it seems like there are quite a few factors and drivers of growth now, and we're seeing an outperformance as well within the entire auto sector. What's your sense as to how long you believe this streak is likely to continue?
Clearly, this seems to be at the nascent levels of recovery in terms of the overall cycle. As you clearly mentioned, many of the headwinds are things of the past. We continue to see good interest in terms of customer demand for new vehicles that have been launched in the recent times. The gross margin expansion is also very likely. And some of the other global macro concerns in terms of chip availability, etc., are also kind of reducing. I won't say it's completely gone out of question, but definitely it's improving. So overall, this is one sector where earnings growth is going to be quite higher than the market average earnings growth for the next 2 years. So to that extent, this continues to be one of the large overweight pockets in our portfolios at this point of time.
Harsha, the flows which have come back into India really have changed the market mood. What is the best way to understand the flows? And I'll just put some data out for our viewers, Harsha, maybe you can take it from there. I was just looking at the flows from COVID low. Foreign institutional investors have sold equity worth 2.8 lakh crore, and domestic institutional investors have bought equities worth 4 lakh crore. So foreigners are still net negative in last 3 years. I'm just thinking aloud that if India is such a great place to be in, and what if FIs they decide to come back to India? I mean, are we looking at a tsunami of FI flows coming back?
Nikunj, very right. Whatever has happened in the over the last 2 or 3 years has been definitely because of the domestic flows rather than foreign flows. Our domestic flows have very well counterbalanced the outflows that we have seen from the foreign side. In the very near term, we have seen a revival in terms of foreign flows. What happened during the October, November, December period was that India, which has always been an expensive market, the valuation premium compared to other emerging markets really expanded. We have always been trading at about 40 to 45% premium to other emerging markets in terms of the valuations. But at that point of time, the valuation premium stretched to almost like 80 to 90%. And that's the time when new year allocations also start to happen. And that's when we saw what we call a kind of a tactical shift towards some of the other markets which had underperformed India by a large margin. For example, China, Taiwan, Korea, etc. So that, to our mind, was more of a tactical shift, because from a structural perspective, I think Indian growth is going to be more resilient than global growth. Point number one. Point number two, most of these economies that I mentioned also have significant exposure to global growth, not as resilient as India in terms of their domestic growth alone. So to that extent, given the fact that how geopolitics has changed, and there have been concerns about how Taiwan and China have been aggressively posturing against each other, very difficult to imagine that the long-term structural money would still go into these markets at the same level as what we have seen in the last decade or so, at least in the near term. So to that extent, India will definitely continue to be a beneficiary of these flows, which will get diverted to other emerging markets. And today, nobody can ignore India. If a portfolio manager is neutral to India, he or she would be looking at least a 14 or 15% exposure to India in the emerging market basket. So to that extent, I think whatever flows will probably get diverted out of China, Taiwan, etc., which are more linked to global growth and have various other issues. Indian flows should continue to remain quite strong, but in the very near term, very difficult to say whether the kind of flows that we have seen in the past quarter will continue to remain on.
Harsha, I'll ask you about a business which you represent, AMCs. And it's a space where we've seen that there is a linear growth. Indians are buying because of asset allocation change, SIP, digitization. But AMC stocks have done little. They've not created a lot of wealth. Now that there seems to be a view from SEBI that the TR norms could be diluted than what markets earlier was faring, is it a good time to, let's say, be a contra buyer in some of these AMC stocks?
Nikunj, we should remember that the final guidelines are still not out. So to that extent, that overhang continues to remain. But if you are looking at a very long-term perspective, then clearly the financial assets have very low penetration in Indian context. So to that extent, mutual funds will continue to remain as one of the favored investment destinations. So in terms of growth rates, yes, the AMC growth rates will continue to remain quite healthy. But what happens to profitability, we will have to wait and see how the final guidelines would shape up from a regulator going forward.
Which is one niche consumption or a new consumption area which you are excited about? I mean, where do you think the consumption puck is going to move? I mean, it's no longer with staples because they're expensive and penetration levels are strong. What is that area which you've identified where you think the consumer basket is going to expand exponentially next 2 to 3 years or 4 to 5 years?
Clearly, if you look at consumer discretionary or consumer staples, both of these sectors have quite a rich level of valuation. So to that extent, even if things turn around, you may not see very large upside. However, one of the other consumer discretionary areas where we are quite positive is Indian aviation sector. Clearly, there has been a consolidation in the sector there. We have also seen crude remaining at very favorable levels from a margin perspective. So overall, this is something that we are excited about. We have seen a vengeance of holiday traveling and business traveling coming back after the COVID disruption. But even if you account for some kind of a normalization, I think things are going to be quite strong from a aviation perspective. And from a margin perspective also, as I said, as long as crude remains in a range or lower than where we are, then I think that should also be healthy for the sector. So that's something that we are excited about, and we have a positive view on.
What about new age fintech companies? Given the fact that, Harsha, we are seeing a cleanup act, there are recent reports as well that have been acknowledging the kind of changes that have been made, talking about a streak of outperformance now within these companies. Does your conviction lie here, or is it something that you'd avoid completely?
Not at a complete sector level, I would say. We do have some stock-specific positions here and continue to monitor the space. But at the same time, with the kind of sharp run-up that we have seen from the bottom in terms of prices, I don't think there is enough valuation cushion even here. So overall, there are very few pockets in the market, as we discussed earlier, where you can say that there is definitely valuation cushion and you can take a very large incremental exposure. So to that extent, just like many other sectors, even here you need to be more stock specific and more focused on valuations and immediate growth as well.
So, Harsha, if one has to invest in the market right now and somebody says, Harsha, I will put a gun to your head and you have to answer this honestly. Are you ready for this question? Yes, give me an honest answer. Honest answer, right? I'm not telling you to predict the World Cup winner, don't worry.
Yeah, maybe that's much easier.
Which is one non-Kotak AMC you would ever invest in?
Currently, we do not have any AMC in our portfolios, just
Fund,
because
AMC
of the overhang that I spoke
not
about.
Not the stock, not the stock. I correct myself. Which is one AMC where you would invest in an AMC scheme, and that has to be non-Kotak.
Honest answer is I have not invested in any of the other AMC schemes. In fact, all our investments go into our own schemes. So I won't be able to recommend that at least.
Gun to your head, my friend. I put a gun to your head, remember. Now you have to answer.
I would still say one of the Kotak funds. All our funds have been doing quite well. So you can very well invest with us and sleep peacefully.
Would you buy gold for next 2-3 years?
Nikunj, gold, I would say that it will give you a defensive bias. Maybe it will do slightly better than debt, but I don't think it can beat equity returns. We are in a situation where there is a reasonable amount of growth that you can see in the overall economy. The corporate earning cycle has picked up. So to that extent, on a nominal basis, you will definitely see much higher growth from corporates. And assuming that the valuations continue to remain around these levels, then the long-term equity return should also kind of mirror the kind of corporate earnings growth. So that's where we believe that a tilt towards equity in the overall scheme of things should be reasonably good even at this level. But yes, as a defensive allocation and maybe to cover a little bit of a debt allocation, you could look at gold.
Right, Harsha, great to have you on the show. We'll let you go on that note. Good speaking with you as always.
Thank you, Aisha. Have a good day.